Hi, we're going to start now with chapter 24, where we're going to start looking at the methods that we use to analyze financial statements. Um, we call that ratio analysis. So we create ratios to look at various parts of the financial statement. Ratios enable us to look at different companies and compare them, different size companies, look at a company over time. And they're extremely useful because they take the dollars out of the equation and just make it percentages. They're used by lots of different people. You're going to hear these ratios thrown around if you end up in a corporate environment all the time. Current ratio, quick ratio, debt to equity ratio, um, all sorts of different kinds of ratios that tell you a lot about um, a company and how it manages various parts of its finance. So important to know about. The ratio, the common ratios are all listed in chapter 24. I'm not going to go through them in this lecture, but I expect you to read them and understand them. Um, Ratios can be used both externally by outsiders, so people lending money or investing use ratios, and then they can also be used internally by management to figure out what the strengths and weaknesses of their organization is. So um, you have to ratios without some comparative basis don't really do much for you. So you need some kind of a benchmark. So the benchmarks for ratios tend to be trend analysis, so your own history, so what's happening with a particular ratio over time. So 5 years ago, our gross profit margin, which is a ratio, was 38%. 4 years ago, it was 39%. 3 years ago, it was 40%. What's happening? Our gross profit margin is increasing. Why? What's making our gross profit margin grow? Obviously a good thing, but we need to know why. So that's the kind of thing you're going to do. You're going to use a historical or trend line to understand a ratio. You may want to look at your competitors. So take that same gross profit ratio, gross profit margin, and say, well, we're at 40% and our competitors are at 43%. How are our competitors doing that? Why aren't we making as much on the sale of each product as our competitors who are in a similar business? So comparing our ratios to the ratios of competitors gives us the competitor becomes the benchmark rather than our historical data. And finally, we might want to use an industry-wide number. Those are a little bit harder to obtain, but most industries have some kind of a benchmarking process that allows you to get a compendium of the entire industry so you can compare yourself to the average. For instance, in the businesses that I was in, the National Sporting Goods Association compiled benchmarks. They compiled a cost of doing business survey, which was administered by one of the large accounting firms. And they asked members of the association to send in their financial statements. Most of these companies were privately held, not publicly held, so they weren't public statements. And the accounting firm promised that those financial statements would remain confidential, but then they compiled them to come up with averages for the industry. So, and then the association then sold those reports to people who wanted those benchmarks. Um, I used to work and provide my numbers to that association because if I provided the numbers, then I got the benchmarks free. So the payment for providing your financial statements was that you got the report free. So that happens in lots of industries. In some industries, these numbers are actually published. The big public industries, like say the auto industry or whatever, all of those numbers are very commonly available. So when we're comparing the history, we're going to compare the current year with past years, and we're going to look at trend analysis, which I've already talked about. What's the trend in gross profit margin? And then we're going to potentially look at exception analysis. Well, if things are staying the same, I'm not going to spend a lot of time analyzing the things that are staying the same. But if something either improves or degrades dramatically, I'm going to spend a lot of time looking or analyzing that. What happens if my cost of goods sold as a percentage of sales increases dramatically? Why did that happen? So I'm going to jump all over that and figure out why my cost of goods sold has gone up. What happens if my freight expense goes up dramatically? Why did that happen? So I'm going to look at exceptions, things that stay the same. I'm not going to spend as much time on. When I look at competitors, I'm going to compare my results specifically to those competitors that are similar. May help me focus on things that I'm not as good at that I could be, that I'm not maybe doing it as well as the rest of my peers in the industry. And it may almost also show me where my competitive advantages are. Things I'm doing better than other people may be my unique competency. I may be really good at some portion of the business. That's good to know if you're in a business. What am I really good at? I'm better than all my peers at this. I'm not as good at that, so maybe I need help in that area that I'm weak, and maybe I try to exploit the area that I'm strong. That's that kind of thing. And then industry-wide, the kinds of reports that are out there, I already talked about industry associations. Those are usually only available if you pay for them, though sometimes that's not the case. Sometimes you can get information that's readily available to anybody. The Journal of Commerce has lots of information about the transportation industry, specifically the maritime transportation industry. And some of their information is for sale and some of it is free. So you can search the Journal of Commerce websites for various kinds of data. Dun & Bradstreet is somebody who compiles information and sells it mostly to people who are granting credit. So they sell their information to banks and to credit granting companies. So if I'm selling something to a company, I can pay for Dun & Bradstreet's information relative to their payment history and their ratios. So they have a database of significant database of companies, sort of like a credit rating agency for an individual. They provide that same kind of information for companies. And there are others. So in the assignment that you're going to have, I'm going to give you some information on how to maybe get some industry-wide comparisons for your companies, the companies you're going to analyze, and hopefully that will help you find some of that information. So common sizing means taking everything in a balance sheet and an income statement and converting it to a percentage. This is what your assignment is going to be. Actually, you're going to common size some balance sheets and income statements using live data. So once we've common sized, we can compare two different firms even though they might be very different size. So you can have a firm doing, let's say, $5 billion a year in business and another firm doing $500 million a year in business. Obviously, their dollar figures are crazily different. One is 10 times larger than the other. However, you can compare their ratios because they're in the same business. If they're in the same business, you compare their ratios. And the ratios are common sized. They're just percentages, not raw dollars. You have to be very careful in using common sizes across industry because different industries are often so different that the comparisons don't mean much. So if you think about, let's say, software or railroads, trying to compare a railroad company to a software company is almost impossible on a common sizing basis. Railroads have huge amounts of long-term capital assets, rail beds, rolling stock, rail yards, locomotives. Software firms have almost no capital stock, long-term capital investment other than some office buildings. So there's no way to really compare those two industries. They do very different things. They operate on very different bases, and so that kind of cross-industry comparison is not particularly useful and might give you you might get some erroneous answers. So be careful when you do it across industries, but within industries, it's very, very useful. So the way that you're going to common size is within a balance sheet. The denominator for all of your percentages is going to be assets or liabilities. So assets and total liabilities and equity and assets are equal, so either of those numbers. So if I've got X dollars in cash, I'm going to divide cash by the total assets, and I'll know what percentage of cash I have. So that's the common sizing. For the income statement, the denominator is always total revenue. Cost of goods sold as a percentage of total revenue, gross profit as a percentage of total revenue, interest expenses as a percentage of total revenue, and so forth. So when you're common sizing, first you have to compute the ratios, which is pretty easy. We're using spreadsheets. But that's just the beginning. Now you have to use that information to analyze what's going on. So if you're using exception analysis, you're going to dig into the detail when your attention gets called to a certain account. So we've got an account that changed dramatically year to year. We're going to dig into that account. We're not going to look at the accounts that are relatively stable on a common size basis year to year. Or if we've got a ratio that's very different from one company to another company in the same industry, we're going to look at that. So ratios give you a guide. They tell you the things you should be looking at, and then you have to actually look at those things. So they don't tell you everything. They just help you analyze. So I'm going to look at a couple of common size statements here. These are out of your textbook. So we've got Pacioli Wholesale, and you've got 2012 and 2011 assets shown here. So you starting out with cash, you've got $8,000, I guess, in 2012 and $7,000 in 2011, and that 8,000 divided by 299, cash is 2.7% of total assets in 12 and 2.5% in 11. Pretty close to the same. As you go down here, you can look at these numbers, 4 and 3.2, not a big difference. Here's receivables. So accounts receivable, 10.8% down to 7.4. So we have fewer receivables. That means something. It means either we're collecting our money due from our customers faster, or it means we're selling less. So you have to look at the income statement to know whether we're selling more or less. But we're certainly collecting. We have less outstanding money from our customers, so we're doing something. And then our inventory increased pretty dramatically, almost 20%, from 14.4 to 16.4% of assets. That's a pretty big change. Unless our sales are also increasing, we have to look at sales as well. And in your chapter, you're seeing the inventory turnover ratio, a really important ratio for logistics students. What's happening here? If our sales are up 20% and our inventory is up 20%, well, we're managing our inventory about the same. If our sales aren't up, let's say our sales are flat and our inventory is up 20%, what's going on? Why do we have so much inventory? And so forth. So you can go through each and every one of these accounts and compare. It looks like we bought some more fixed assets. Our depreciation, obviously increased, but it increased as a percentage of assets as well because we're depreciating this new asset, I assume. And our goodwill went down. That probably means we had some kind of an impairment. So that's the asset side. Same thing on the liability side. We can go through here and we can quickly go down. Now, our mortgage as a percent, our debt is down. We have $145,000 in debt. Last year we had $150,000. And as a percentage of total liabilities, it's down even more because total liabilities and equity have increased. Retained earnings is up substantially, which means we must have made a fair amount of money this year, which we'll see on the income statement. So there's your liabilities, and here's an income statement. Sales increased from 250 to 300, so there's a nice increase there. So that may account for the inventory increase. Cost of goods sold, wow, gross profit up almost 4%. That's a huge increase in gross profit from 42% to 45.5%. Big increase in gross profit. That's a good thing. Now why? What's going on? How come we're all of a sudden able to increase our gross profit margin? Selling expenses, general expenses, and administrative expenses stayed the same relative to sales. So all of that increase in gross profit is going to go to operating income and then down to net income. So your gross profit is up from 103 to 135. Your net income is up from 11 to 19. That's a huge increase percentage-wise in net income. So my net income is up almost 50%. So 4.5% to 6.4% of sales. Huge increase. And that's also reflected back here in your increase in retained earnings. So Pacioli is doing really well this year. Now we know what we need to look at. Why is gross profit up so much? What's going on with receivables? How are we managing? We're increasing sales, but we have fewer receivables. We're doing a fabulous job of collecting. Something's happening for Pacioli that's good. What's happening and why? So ratios that are listed in your chapter, they're a really good way of understanding relationships. They're very commonly used. You hear these ratios discussed in almost any kind of a corporate financial setting, whether you're a financial person or not. What's your turnover, your inventory turnover? If you're in the logistics world, that's a huge number. That basically that gives you a ratio that tells you how efficient you are at handling inventory. I mean, that's the primary benchmark for most logistics operations. How quickly and efficiently do we manage our inventory? So, you know, if you're in a logistics department, people are going to, you have your meeting with your peers in, say, the finance department. They're going to say, oh, what's happening with the inventory turnover? Is it up or down? You may even be compensated on how well you manage that ratio. And there are lots of other ratios as well. So they're very commonly used. You should know you should know what the basic ones are because you're going to hear them and you don't want to be a dummy and not know what they mean. So you should learn the basic ones that are listed in the chapter, and you'll probably get asked something about them on your first quest from me. So let's get on to the assignment here. I'm going to ask you each to prepare a common size balance sheet and income statement for Kirby, you've already looked at, KEX, and another maritime company called Tidewater, which is TEW. I'm going to show you how to go to Edgar and do this quickly and easily. I'm not interested in you spending hours reconstructing Excel spreadsheets, but Edgar is nice enough to, the SEC is nice enough to allow you to download the financial statements in Excel format and then manipulate them, which makes life really easy. So I'll go through a little tutorial on that when we finish this little lecture. So I'm going to ask you to prepare common size statements, then use those statements to provide an analysis of changes in each of the company's financial position. I want at least 3 years of balance sheets analyzed, and I want at least 4 years of income statements analyzed. You can use the ratios that are in Chapter 24 as one method for your analysis, and also look at trend analysis, what's happening up and down as the companies change over time. And they're both in the maritime industry. They're both somewhat tied into the oil industry, so there's a lot of change over time for these two companies. So I want you to compare and contrast the two companies. If you can get industry data, I want you to compare that also to industry data. So you got to do a little research to see if you can get some industry data that would help you compare. So other maritime companies that are similar to these companies. And I want you to tell me a logical cause supported by the data for any significant differences that you've noted. So the two companies, that Tidewater and Kirby, may have very different operating philosophies. They may have very different ways of using capital. They may have very different financial structures. And I want you to tell me why these differences are there and why these companies have chosen to do what they've done, and perhaps your opinion of which company is doing a better job of managing that process. I want it turned in as an Excel spreadsheet. The industrial codes that would help you find some industry analysis or industry data are available at that web address there, www.naics.com. National Industrial Coding System, maybe. I'm not sure exactly what NAICS stands for, but it'll give you the SIC codes, the industry codes, and you can then do some searches on the web looking for those information under those industry codes. And obviously you've already done this, but we're going to go to the SEC site to get the information for these companies. So I'm going to switch out of the PowerPoint here and go online to the SEC site. And let's see if I can do this efficiently. I'm going to SEC Edgar. I'm going to click on that, and I'm going to put in the ticker symbol for Kirby, KEX. Oops, not, I mean, KEX. I'm going to hit return, and see if I can make this smaller. And we get to Kirby Corp, and we see their information. And we want to go to their 10K, and we're going to click on interactive data. So before, when you went to the 10K, you went to documents. This time you're going to go to interactive data, and you're going to go to view Excel document, and it downloads, you can see right here, it downloads the Excel document for all of the data in this 10K. I'm going to open this up. Try to make it fit in my little box here. There we go. And this is Kirby Corp for December 31st, 15, filed on February 19th, 16. And along the bottom, you've got all your tabs. And the very first tab is a consolidated balance sheet. Well, there's your Excel balance sheet for Kirby. So you've got current assets, property, plant, and equipment, total assets. So right to this point, we've got total assets. And I'm going to change that to enable editing. And then I'm going to change that to bold so I can find it. And at this point, I can start my common sizing. I've asked you to do 3 years of consolidated balance sheets. If you continue to page down through Kirby's filings, you go a year earlier and you will find last year's 10K, which will have December 14 and December 13 in it. You're just going to copy, you can download the Excel file again, copy out December 13 and paste it right here. So you can have 3 years of data. I'm now going to do, and for many of you this may be just, you understand how to do this, but I want to show you how to easily create a common size balance sheet, and it really doesn't take very long. So I'm going to insert a column here, and I'm going to make this my percentage column. I'm going to format it so that it does percentages, and I'm going to do 2 decimal places. I could do 3 or 4 if I wanted, but I think 2 is plenty. And then I'm going to take the very first item, which is cash and cash equivalents, and I'm going to common size it. So I'm going to say equals this divided by this, and this B20 I'm going to make a constant so that it doesn't change as I copy down, because this 4 is going to be, we're going to use this $4.1 billion as the constant divisor for all of these items. And to do that, I could put a $sign in front of the B and a $sign in front of the 20. Excel, if I hit function key 4, it does that for me, so I don't have to actually type in the $signs. Oops, what did I do? Nope. Nope, nope, nope. And then I'm going to hit return. So 0.14% of our assets are cash. And now I can just take this, I can grab that little box there and I can drag it down. And look at that. I have all of the items as percentages. Total assets is 100%. Everything else is calculated. The blank lines are coming in as zeros. I can just delete those 2. And I've now common sized the asset side of my balance sheet. I can do the same thing for 14 and so forth. So pretty easy. To do the whole balance sheet will probably take 5 minutes once you get used to doing this. And now I can, let me just do the next one. So this is going to equal this divided by this. And we want to make this a constant. So we're going to do that and select F4. Hit a return. Oops, I didn't change this to a percentage, so I'm going to change it to a percentage. Put a header on the column. Center it. And then I can do the same thing here. So at this point, cash as a percentage of the total has dropped. Accounts receivable dropped significantly. We had 417 million in receivables at the end of 14. We only have 290 million in receivables at the end of 15. That's a good trend. We'd rather have less money owed to us from our customers. But we want to see this, we're going to want to see this as a turnover ratio as well. You'll find receivable turnover ratios in your in your Chapter 24 ratios, what does this mean? Now, if my sales have dropped equivalently, this is like a 30% drop here as a percentage of assets. So we're collecting receipts faster, or maybe our sales drop 30% and therefore our receivables are down because we're selling less stuff. That's the kind of stuff you want to look for. Inventories, not too big of a change. Prepaid expenses, not too big of a change. Deferred income taxes, not a very big change. Total current assets changed, but most of the change came from this one line, which is receivables, which means that's the thing I really want to look at. All the other stuff is consistent. What's happening with receivables? Either I'm doing a really good job collecting, or I might have more bad debts that I've written off, because you've got your allowance here for bad debts. So they've got $9 billion written off here, $9 million, I guess it is, 8 million written off here. Not a big change in write-offs, so probably not that. And then property, plant, and equipment has increased. So this is total equipment here. You can see this is 98%, but then we've got depreciation. So really what you're looking at is this line here. Let's bold that. That's property and equipment net of depreciation. So here's all your equipment. And then here's your depreciation. And then you've got your net. So this is the actual asset. All of this stuff is netted out. This is the accumulated depreciation is a contra asset. Investment in affiliates, goodwill, other assets. So the things we're probably going to spend some time on this one, at least it would appear, is you're going to spend some time on property and equipment, and you're going to spend some time on receivables, and so forth. You're going to go through the liabilities the same way. Liabilities, your constant is going to be down here, and you're going to divide into it, and so forth. As you go across the bottom of this chart, you see all the stuff at the bottom here. We can just page across here. Consolidated statement of earnings. Consolidated statement of earnings is here. So there's your income statements. And you've got 3 years there. I've asked you to do 4. So if you go back to 14's 10K, you'll find December 30th, the first 12 in there, and you can drop that in. Make sure when you pick up the ones from last year that the accounts line up. Sometimes they will change format a little bit, so make sure that your accounts from 2012 line up with your 15, 14, and 13 accounts. That's an easy mistake to make. Don't make that mistake. Okay, so that's how you do it. Your assignment, I think, is relatively clear. If you have any questions, you can email me. Good luck with this. This will be due on Wednesday, June 22nd. So today is the 12th, Sunday the 12th. It's due Wednesday, June 22nd. And that's the middle of the week. I know we usually have assignments due on Saturdays. You can do this and get it done by Saturday. That's Saturday the 18th. That's fine. I'm giving you a few extra days to do it. And then on the 22nd, we'll open a discussion of what you found, similar to the discussions you've done so far, so that you can all share your information and the kinds of things that you found. Thanks very much, and see you next week.